Hi and welcome. You're listening to the X22 Report. My name is Dave and this is episode 1097A and today's date is October 10th, 2016, and the title of the episode is The European Banking Crisis is Much Worse Than the Central Bankers Let On. Let's get into the economic collapse financial news. Now, we have been watching the economic indicators since 2008, and we're showing that a lot of these economic indicators are worse than when we were in the Great Recession. Now, we've never ended the Great Recession. All the central bankers have done is extended out. Because if you look at what they've done, they've propped up the banks, propped up the stock market, suppressed the precious metals market, and that's about it. They haven't done really much of anything except continually lower the interest rates. Because when we look at manufacturing, when we look at industrial production, when we look at retail, when we look at housing, when we look at GDP, when we look at unemployment, and I know some of these numbers are manipulated, but when we start to look around and we see what is going on here, we realize the United States government central bankers, they can't really manipulate the part of the economy that has to do with the everyday person. And when we look at these economic indicators, some are equal to or worse than they were at 2008, 2009. So in reality, we have never really come out of this Great Recession. All they've been doing is keeping this thing afloat by propping the banks, the stock market up. That's pretty much it, because they need to keep the interest rates very, very low. Because if they let it rise, if they let the interest rates rise, the system is going to freeze up. And the U.S. government, the corporate media, the central bankers, they keep coming up with more and more excuses of why the economy is not doing well. Now, normally in retail, they say, well, it is the weather. We had snow, we had sleet, we had a hurricane, we had rain, we had whatever they need to use to explain away why retail is not doing well. Well, the latest excuse they have for why retail is not doing what it's supposed to be doing, expanding, because we know it's contracting, they're saying that U.S. retails and restaurants are not doing well because of the election. Because the people are preoccupied with the election and they stay glued to their TV, to their desktops, to their laptops, and they're just not going out there shopping. Now, this is absolutely ridiculous. But they're doing whatever they possibly can to explain away why all this is happening. But when we look at the economy, we continually see that there are more and more indicators letting us know there is something wrong. Now, in August, commercial and industrial loans outstanding at all banks in the U.S. fell for the first time month to month since October of 2010, which kind of marked the end of the collapse of the credit during the financial crisis. In October of 2008, the absolute peak of the prior credit bubble, there were 1.59 trillion commercial and industrial loans outstanding. As the Great Recession continued on, many of them were cleansed from the bank balance sheets via charge-offs. But then the Fed decided what the U.S. needed was more debt to fix the problem of having too much debt. So they added more debt, which we can see with everything around us. Auto loans, student loans, and on and on and on. So what we're seeing right now is that in July of 2016, loans had surged to 2.064 trillion, 30% above their prior bubble peak. So we're above the peak of 2008 already. Now in August, it dropped off a little bit, about 2.058 trillion, which is about 0.3%. And this is according to the Federal Reserve Board of Governors. That translates into an annualized decline of 3.8%. In September, U.S. commercial bankruptcies filing soared to 38% from a year ago to 3,072, the 11th month in a row, year over year, of increases. And this is according to the American Bankruptcy Institute. For the first 9 months of 2016, commercial bankruptcies jumped 28% compared to the same period in 2015. So most of these that we're hearing from the corporate media, well, they're not the bankruptcies that we normally hear about, because most of them are small businesses. And what we're seeing right now is that bankruptcies are on the rise. The credit bubble is above the 2008 crisis. And we can see where this is all going to end up here. And this is another indicator showing us that things are a lot worse than the central banks are letting on. And then we come to GDP. Now we know the Fed is out there, the IMF is out there, and they keep telling us how great it's going to be, and they come up with these crazy numbers. Oh, we're going to hit 3.2%, we're going to hit 3%, and they continually revise over and over and over. And when we look at this, we can see there is a pattern forming. Now, the Atlanta Fed already dropped its estimates for the third quarter of GDP growth 2 full basis points to 2.1%. Last year's fourth quarter growth were high. The Atlanta Fed expected a robust 2.6% growth, but guess what happened? It revised it down to around 0.7%. Then, of course, they revised it up a little bit to 1.4% to make it look a little bit better. And we can see right now, they continually do this. Because when we look in 2016, the first quarter there, we saw the same pattern. Expectations were very high. They said we're going to have about 2.5% GDP growth. And of course, what happened? It ended up at 0.6%. We saw the exact same trend in the second quarter of this year, where they were saying, oh, this is going to be fantastic. We're going to see growth of 3%. In just 2 short months, the expectations plunged to 1.8%. So clearly there is a trend. The U.S. economy is steadily weakening. The central banks, they're trying to cover this up. They're trying to, trick everyone to think that this time it's going to be different. And then they do their little revision, and hopefully people forget about it. They only think about that first number that they put out there. But what we're seeing right now is that GDP, as it continually declines, the bottom line right now is that our economy is not healthy the way the Fed is portraying it, the way the politicians are portraying it. It means the U.S. stocks are overvalued and due for a fall. It means the Fed can't possibly raise rates anytime soon. It means that this system is contracting because we're seeing everything contract. Think about it. Retail has been contracting. The housing market is contracting. GDP is contracting. We see the credit bubble much larger than 2008. We see bankruptcies are on the rise. Corporate defaults are on the rise. Corporations are laying off people. And all of this points to one giant contraction. That's what we're seeing. And we know how this all ends. In one gigantic collapse. Now, we understand that Deutsche Bank, they are trying to dig their way out of this hole that they're in. But as they continually dig, it gets deeper and deeper and deeper. And we see today that Deutsche Bank, well, they kind of cheated on their stress test. The Financial Times is reporting that Germany's largest lender was allowed to cheat. A pardon was given special treatment by the ECB in the July stress tests. As part of the July stress test results, which promised to restore faith in Europe's banks by assessing all their finances in the same way, well, Deutsche Bank they kind of cheated with a special concession agreed to by Mario Draghi. Deutsche Bank's results included the $4 billion in proceeds from selling its stake in Chinese lender UZ, even though the deal had not been done by the end of 2015. The official cutoff point for the transaction was to be at that point. And we can see right now is that it is still not completed and now faces a delay after missing regulatory deadline last month. So none of the other 50 banks in the stress test had similar footnotes, even though several also had deals agreed but not completed at the end of 2015. So Deutsche Bank was allowed this pardon, this cheat, this leeway, whatever you want to call it. They manipulated the stress test. And all these stress tests are ridiculous anyhow. They were designed to convince the world that the banking system is absolutely fine. And they were using it as propaganda to convince the world that the central bankers have everything under control. Well, they don't. We know they don't. We see the IMF is warning that the banks in Europe, well, they're too weak to generate sustainable profits, even if the region saw strong economic growth. And that hasn't happened for years anyhow. Now, the IMF is out there saying that we need to take caution because the banks, well, they're not profitable, and they're caused by subdued growth in the Eurozone and ultra-low negative interest rates. In Europe, about 1/3 of the system, representing about 7.5 trillion euros in assets, remains weak and unable to generate sustainable profits. So what this tells us is that this entire banking system, it's not strong, never recovered. The banks are insolvent. They cheated on the propaganda stress tests because they can't even use the propaganda the way it is. They have to cheat to make it look even better than it really is because these banks are so bad off that one little black swan event brings the entire system down. And this is what we're seeing right now. Now, they might be able to prop it up for a little while longer, which they normally do, but this is a Band-Aid fix. This is not going to last because the problem is going to continue on. What do you think happened in 2008? Just think about this for a second. We had a subprime security problem here. Banks, credit problems, the mortgage-backed securities, they were completely garbage, but they kept the illusion alive for many years, saying that they were all AAA. There's nothing wrong with them. There's nothing wrong within the mortgage-backed securities. No one's defaulting. Everything's great. Real estate's fine. It's all contained. Bear Stearns is contained. Lehman's contained. AIG, everything is contained. And then all of a sudden, everything started to unravel. All the lies, everything they've been telling us was untrue. Now, hundreds of millions of people believed what the central bankers were saying. They believed what they were talking about. They believed that these were AAA, that everything was A-OK. And then there was a handful of people saying, no, we don't believe you. We know something's happening. We know something's wrong. And we know that this can't last forever. No matter how many pieces of tape you put on this and try to convince the public that everything is fine, something will give. And those few who are out there telling the world this, of course, they were laughed at. They were saying they were ridiculous. You don't know what you're talking about. Because the hundreds of millions of people were right. The few were wrong. And then the crash came. The system unraveled. And the few, they were right. The hundreds of millions of people were completely wrong. We're in the same situation, everybody. The few are looking into what is really going on. The few are looking at each economic sector, putting the pieces together, saying there's something wrong here. It makes no sense. what the central banks, what the U.S. government, what the manipulated numbers are telling us, they do not make sense. Now, can they keep the illusion alive? Yes, for a certain period of time. But eventually what will happen is it will unravel. And hundreds of millions of people who have believed the governments, the central banks, are going to be in shock. The few are going to understand what is going on. Then the few are going to be looked at as, how did you know this? And the simple answer to that was, we didn't follow the propaganda of the central banks, the propaganda of the U.S. government, and we were the ones who were peddling fiction at the time. And now we see everything has turned around. The government, the central bankers were peddling fiction. We were telling the truth. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.